Welcome to the final installment of Corporate Digital Sovereignty, our five-part exploration of how tech giants are reshaping money as we know it. I'm Kaede, and today we're examining the broader implications of corporate digital currencies for economic sovereignty and democratic governance. In our previous episodes, we introduced Horizon Coin as our case study, explored how these currencies can outcompete national ones, investigate the profound privacy implications of merged payment and behavioral data, and analyzed how corporate financial systems evolve into critical infrastructure. Today, we're focusing on perhaps the most fundamental question of all: what these developments mean for power distribution in digital society and the choices we face at this critical crossroads. Throughout history, societies have recognized that monetary systems represent more than mere technical arrangements. They embody fundamental choices about who creates value, who controls access, and who sets the rules governing economic participation. The ability to issue currency and control monetary systems has traditionally been among the most closely guarded sovereign powers, not simply for economic reasons, but because monetary functions reflect essential aspects of collective self-determination. But today, we're witnessing something unprecedented: the rapid emergence of new monetary systems developed not through democratic processes, but through corporate initiatives optimized primarily for engagement and shareholder value. This transformation isn't just changing payment mechanisms, but potentially restructuring the relationship between public institutions and private platforms in ways that fundamentally reshape economic governance. In this final episode, we'll examine how the accelerating timeline of digital currency adoption frequently outpaces regulatory understanding and response. Explore the emerging governance vacuums where traditional jurisdictional boundaries become increasingly irrelevant, and investigate the sovereignty paradox, where convenience-maximizing individual choices gradually establish significant collective dependencies. To ground these abstract concepts, we'll tell the story of a small nation navigating the complex tensions between immediate economic benefits and long-term sovereignty considerations. By drawing on historical examples of major monetary transitions and current research in digital governance, we'll explore how societies have repeatedly faced similar crossroads moments where technical innovation outpaces governance frameworks, and what those precedents suggest about our current moment of decision. To understand the governance challenges posed by corporate digital currencies, we must first recognize the fundamental timeline mismatch between technical innovation and regulatory adaptation. Traditional financial governance developed through deliberate processes, specifically designed for careful consideration, regulatory frameworks evolving through public consultation, legislative deliberation, and incremental implementation. This created what governance scholars call adaptive regulation, where oversight frameworks could evolve in response to emerging challenges while maintaining essential stability. These systems weren't perfect, but their development pace allowed for thoughtful consideration of complex trade-offs and stakeholder interests before widespread adoption of new financial mechanisms. It's like the difference between carefully developing traffic laws before roads become congested versus attempting to implement rules on highways already filled with vehicles moving at high speed. Corporate digital currencies fundamentally transform this paradigm through accelerated deployment, where technical capabilities advance and scale before governance frameworks can develop. Market-driven adoption, where implementation follows engagement rather than regulatory considerations. And private development, where systems evolve through proprietary rather than public processes. This creates what researchers call governance lag, where technical innovation substantially outpaces regulatory understanding and response. The deployment typically follows a predictable pattern: rapid technical development creating new capabilities, compelling commercial implementation driving quick adoption, widespread integration establishing significant dependencies, and only then reactive governance attempting to establish appropriate frameworks after systems are already deeply embedded in economic life. This fundamentally inverts the traditional sequence, where governance frameworks typically preceded widespread adoption of new monetary mechanisms. The technical and commercial forces driving this acceleration include development incentives, where market advantage rewards first movers, network effects, where early establishment creates self-reinforcing adoption patterns, and competitive pressure, where market participants face existential threats from disruptive alternatives. These dynamics create what economists call regulatory arbitrage opportunities, where governance gaps can be strategically exploited for commercial advantage. The most significant concern isn't the acceleration itself, but rather the development of deeply embedded systems operating through fundamentally different principles than traditional financial infrastructure. Optimization for engagement and commercial metrics, rather than stability, equitable access, and democratic accountability. The rapid pace doesn't just challenge regulatory adaptation, but potentially establishes new default arrangements before societies can thoughtfully consider their implications. The governance challenges of corporate digital currencies extend beyond simple timeline mismatches to create what legal scholars call jurisdictional uncertainty, where traditional governance boundaries become increasingly ineffective for systems operating across digital domains. Traditional financial governance operated through clearly defined jurisdictional frameworks where regulatory authority aligned with territorial boundaries, institutional oversight where specific agencies held clear mandates, and enforcement mechanisms with well-established procedures. This created what legal experts call governance clarity, where authority, responsibility, and accountability maintained relatively clear alignment despite occasional jurisdictional tensions. While traditional financial governance certainly had limitations, the basic question of who held authority over particular functions or activities rarely generated fundamental uncertainty. Corporate digital currencies fundamentally transform this landscape through borderless operation where activities transcend traditional jurisdictional boundaries. Functional complexity, where novel mechanisms defy straightforward categorization. And definitional ambiguity, where systems simultaneously resemble multiple regulated categories without precisely matching any. This creates what governance researchers call regulatory interstitials, where activities occur in spaces between clearly defined jurisdictional domains. The practical manifestation includes competing claims where multiple authorities assert partial jurisdiction, governance gaps where critical functions lack clear oversight, and forum shopping where operations strategically locate to minimize regulatory constraints. These dynamics create substantial uncertainty about fundamental governance questions: who establishes rules, who ensures compliance, and who adjudicates disputes for increasingly essential economic functions. The consequences of this jurisdictional uncertainty extend beyond theoretical governance concerns through accountability deficits, where essential functions operate without clear responsibility frameworks, protection gaps where activities lack appropriate safeguards despite potential systemic importance, and democracy deficits where rulemaking increasingly occurs through private rather than public processes. This creates what political scientists describe as governance vacuums, where essential functions operate increasingly outside established democratic accountability structures. The most significant concern isn't jurisdictional complexity itself, but rather the migration of rulemaking authority from democratically accountable institutions to private platforms without corresponding accountability mechanisms. As governance scholar Julie Cohen observes, the question isn't whether rules will govern digital economic activity, but rather who will make them and through what processes. To understand these abstract concepts in practical terms, let's explore how one small fictional nation, Talitha, with approximately 3.2 million citizens and a developing economy, navigates the complex tensions between immediate economic benefits and long-term sovereignty considerations. Talitha faces significant macroeconomic challenges, including volatile currency fluctuations affecting economic stability, high remittance costs limiting benefits from overseas workers, limited banking infrastructure restricting financial inclusion, and capital flight during economic uncertainty. These conditions create what economists call sovereignty constraints, where immediate economic pressures limit practical autonomy despite formal independence. For citizens, these conditions manifest through everyday challenges, including unpredictable purchasing power affecting household planning, costly payment systems consuming significant portions of modest incomes, and limited financial services restricting economic opportunity and security. Talitha's engagement with corporate digital currencies begins through pragmatic adoption driven by immediate advantages rather than strategic planning. Citizens gradually adopt Horizon Coin for practical benefits, including stable purchasing power, resistant to local currency fluctuations, reduced transaction costs especially for international transfers, expanded service access regardless of location, and interface accessibility requiring minimal financial literacy. Government officials initially view this adoption as complementary to traditional financial systems rather than competitive, a practical solution to immediate challenges without obvious governance implications. The adoption pattern follows a predictable trajectory: initial use for specific advantages like remittances, expansion to daily transactions driven by stability benefits, and gradual establishment as the dominant payment system for both online and offline commerce. The transition happens not through official policy, but through millions of individual decisions prioritizing immediate practicality. As Horizon Coin reaches approximately 30% adoption, Talitha's leadership begins recognizing significant governance implications beyond simple payment efficiency. The emerging concerns include monetary policy limitations, where traditional economic management tools become increasingly ineffective, regulatory constraints, where consumer protection and financial stability standards become difficult to enforce, tax compliance challenges, where significant economic activity operates through systems with limited visibility, and crisis management, where essential economic functions depend on externally controlled infrastructure. These realizations trigger what governance scholars call sovereignty awareness, recognition that seemingly technical financial choices involve fundamental governance trade-offs. The most significant insight involves the distinction between short-term economic benefits and long-term governance capability, immediate advantages potentially creating structural dependencies with significant future consequences for economic self-determination. Academic research provides crucial context for understanding the fundamental tensions between immediate economic benefits and long-term governance implications. In their landmark research on digital sovereignty, German economists Weber and Gross identified the sovereignty paradox that frequently characterizes technology adoption in developing economies, where solutions addressing immediate constraints often create new forms of dependency, potentially more limiting than the original problems. This paradox manifests through immediate gains in practical capabilities, but gradual erosion of policy independence. Increased service access, balanced against reduced governance autonomy, and improved economic metrics alongside diminished institutional capacity. This creates what political economists call tiered sovereignty, where nations maintain formal independence while experiencing progressively limited practical autonomy over essential economic functions. Research specifically examining corporate currency adoption in developing economies identifies unique sovereignty challenges created through monetary policy limitations, where traditional economic management tools become increasingly ineffective. Regulatory arbitrage, where consumer protection and financial stability standards become challenging to enforce. And asymmetric dependency, where essential economic functions rely on externally controlled systems. These characteristics create what governance researchers call functional sovereignty transfer, where practical governance capabilities gradually migrate from public institutions to private platforms despite maintained formal authority. Most concerning is the emerging governance capacity erosion dynamic, where institutional capabilities gradually atrophy as systems operate increasingly outside direct oversight, creating not just temporary constraints, but potentially permanent capacity gaps that prove difficult to reverse even if political will eventually emerges. Emerging research specifically examining corporate digital currencies in developing economies identifies a crucial sovereignty distinction that governmental authorities increasingly recognize, primarily how dependencies operate through technical architectures rather than explicit agreements. Studies document what researchers call infrastructure sovereignty, where control over essential technical systems creates governance capability regardless of formal authority arrangements. This creates what research describes as architecture politics, where technical design decisions have profound governance implications despite appearing purely operational. These dynamics explain why digital sovereignty scholars increasingly emphasize the importance of what they call strategic technology assessment, evaluating not just immediate functional benefits, but long-term governance implications of apparently technical arrangements. The fundamental insight involves recognizing that in digital environments, architecture frequently determines practical authority more effectively than formal agreements. The governance challenges of corporate digital currencies gain crucial context when placed within broader historical patterns of monetary transition. Monetary systems have experienced several major evolutionary phases through commodity-based arrangements where physical materials like gold served as currency. Fiat money systems where government-issued currency without intrinsic value gained acceptance through legal status. And digital transitions where physical cash gradually evolved into electronic representations. Each transition generated what monetary historians call regulatory adaptation cycles, where governance frameworks evolved to address emerging challenges after significant adoption had already occurred. The historical pattern reveals consistent dynamics: initial excitement about new capabilities, rapid adoption preceding regulatory understanding, emerging problems revealing governance gaps, and eventually, new frameworks establishing appropriate boundaries. These patterns suggest digital corporate currencies represent the latest iteration of a recurring historical challenge. Historical examples provide concrete illustrations of how major monetary transitions create short-term regulatory gaps before governance adaptation occurs. The 19th century transition from private banknotes to centralized currency issuance followed decades of free banking, with limited oversight before significant financial instability triggered governance development. The early 20th century establishment of central banking systems involved similar lags between practical financial evolution and regulatory framework development. The late 20th century emergence of electronic payments operated through similar dynamics, widespread adoption preceding comprehensive governance. These historical precedents suggest what monetary historians call governance maturation periods, where societies require significant practical experience with new monetary mechanisms before developing appropriate oversight frameworks. The consistent pattern demonstrates that governance gaps aren't unique to current developments, but rather represent recurring features of monetary evolution. While historical precedents provide reassurance about eventual governance adaptation, they also highlight critical differences distinguishing current transitions from previous episodes. The acceleration dynamic, where adoption occurs substantially faster than previous transitions. The globalization factor, where systems operate across jurisdictional boundaries from inception. And the privatization element, where governance migrates from public to private rather than simply evolving within public domains. These distinctions create what historians call nonlinear evolution, where current developments represent not just accelerated versions of familiar patterns, but qualitatively different transitions requiring novel responses. The most significant historical insight involves recognizing both reassuring similarities, suggesting eventual adaptation, and concerning differences, indicating potentially unique challenges requiring innovative governance approaches evolution. The future of corporate digital currencies will be shaped through competing stakeholder perspectives, representing fundamentally different visions about how these systems should develop. The corporate innovation perspective emphasizes efficiency improvements through streamlined payment processes, user experience enhancements creating intuitive financial interactions, and ecosystem synergies enabling previously impossible service integrations. This vision prioritizes what business strategists call innovation maximization, where technical and experience advances should proceed with minimal constraints to enable maximum creative development. From this perspective, governance frameworks should remain narrowly focused on specific demonstrated harms rather than speculative concerns, allowing systems to evolve organically through market feedback rather than regulatory design. The fundamental assumption involves trusting that competition and user choice will naturally produce optimal outcomes without requiring extensive external guidance. The consumer protection perspective focuses on substantially different priorities through transparency requirements ensuring users understand system operations, accountability mechanisms enabling meaningful recourse when problems occur, and inclusion guarantees preventing harmful discrimination or exclusion. This vision emphasizes what consumer advocates call protection fundamentals, baseline safeguards essential regardless of business model or technical implementation. From this perspective, governance frameworks should establish clear standards applicable across platforms to prevent competition from eroding essential protections through what economists call regulatory arbitrage. The fundamental assumption involves recognizing that information and power asymmetries create markets that won't naturally protect vulnerable participants without appropriate external standards. These stakeholders advocate for governance frameworks developed alongside technical capabilities rather than following years of unregulated deployment. The public interest perspective extends beyond individual consumer concerns to emphasize broader societal considerations through democratic accountability, where system governance includes appropriate public oversight, sovereignty protection ensuring nations maintain essential economic policy capabilities, and infrastructure resilience guaranteeing stability for increasingly essential systems. This vision prioritizes what governance scholars call democratic technology development, where innovation proceeds within frameworks reflecting collective values rather than purely commercial priorities. From this perspective, governance should involve diverse stakeholder participation rather than narrowly commercial metrics, recognizing that monetary systems fundamentally shape social relationships beyond immediate transactional functions. The fundamental assumption involves understanding digital currencies as social infrastructure requiring governance, reflecting their increasingly essential role in collective economic life. The evolution of corporate payment systems creates what access researchers call the next digital divide, where financial inclusion takes new forms through technological rather than geographic boundaries. Traditional financial inclusion challenges operated primarily through physical limitations, where banking services remained unavailable in particular locations, documentary barriers restricting access through formal requirements, and minimum resource thresholds establishing economic barriers to participation. These challenges created what inclusion specialists call geographic exclusion, where financial services remained physically unavailable for significant population segments. Financial exclusion certainly represented a serious problem, but its primarily physical manifestation created relatively straightforward conceptual solutions despite implementation challenges, essentially extending existing services to previously unserved locations. Corporate digital currencies fundamentally transform this landscape through ubiquitous availability, where services become theoretically accessible across previously excluded regions, simplified onboarding where documentary requirements typically decrease, and reduced transaction costs enabling smaller financial activities. These characteristics initially suggest significant inclusion benefits, addressing traditional barriers that previously restricted access for marginalized populations. Implementation occurs through mobile interfaces requiring only basic smartphones rather than physical infrastructure. Streamlined verification leveraging digital rather than documentary evidence, and microtransaction capabilities accommodating substantially smaller economic activities. This creates what inclusion researchers call technical accessibility, where services become theoretically available to previously excluded populations through technological rather than institutional expansion. However, this digital transformation creates new exclusion forms beyond geographic limitations through digital literacy requirements, where service access depends on technological capabilities. Connectivity dependencies, where participation requires reliable internet infrastructure. And algorithmic assessment, where automated systems determine service eligibility without transparency or appeal mechanisms. These developments create what researchers call algorithmic exclusion, where participation depends increasingly on factors invisible to users themselves. The societal implications include assessment opacity, where eligibility determinations occur without explanation, exclusion persistence, where rejection patterns potentially reinforce existing disadvantages, and recourse limitations, where decisions operate without meaningful appeal processes. This represents what digital inclusion experts describe as the next financial frontier, where technical barriers replace geographic limitations as primary exclusion mechanisms, requiring fundamentally different policy approaches, focused on algorithmic governance rather than simply physical expansion. The governance debates surrounding corporate digital currencies ultimately center on fundamental questions about ownership structures for essential financial infrastructure. Traditional financial systems operated through various ownership models, including public infrastructure, directly operated by governmental entities, regulated utilities functioning through private ownership with significant oversight, and mixed systems combining public governance with private implementation. These arrangements created what economists call aligned incentives, where system operation generally reflected broader public interest considerations despite occasional tensions. While traditional financial governance certainly generated conflicts between public and private interests, the basic frameworks typically acknowledged the essential nature of financial infrastructure through special oversight arrangements, regardless of formal ownership structures. Corporate digital currencies fundamentally transform this landscape through platform ownership, where essential functions operate through commercial entities with shareholder rather than public accountability. Engagement optimization, where systems prioritize platform participation over stability considerations. And commercial value extraction, where operational decisions reflect revenue maximization rather than public utility principles. These characteristics create what governance theorists call incentive misalignment, where operational priorities potentially conflict with public necessities in system design, implementation, and crisis response. The implementation occurs through commercial platforms where governance reflects business priorities, proprietary systems where operational details remain corporate rather than public knowledge, and shareholder accountability, where success metrics prioritize commercial rather than social considerations. This creates fundamental tensions between platform operation and infrastructure requirements, as systems evolve from optional services to essential components of daily economic life. Emerging governance proposals suggest various approaches for addressing these structural tensions without necessarily requiring dramatic ownership changes through operational separation, where essential functions maintain distinct governance from commercial activities. Enhanced oversight establishing appropriate accountability for critical functions, and public utility designation creating special obligations for systems reaching infrastructure thresholds. These frameworks reflect what policy specialists call functional regulation, where governance arrangements reflect essential roles rather than formal organizational structures. The most promising approaches involve recognizing legitimate innovation benefits while establishing appropriate safeguards reflecting increasingly essential functions, essentially creating hybrid governance models acknowledging both commercial origins and infrastructure evolution. The fundamental insight involves understanding that governance arrangements must evolve alongside functional transformation. When optional services become essential infrastructure, their oversight frameworks should reflect this critical transition. As we conclude our exploration of corporate digital currencies, let's identify 3 essential questions that will shape their development and implementation. First, how should governance responsibility distribute across stakeholders through appropriate public oversight ensuring democratic accountability, industry self-regulation establishing consistent standards, and user empowerment enabling meaningful choice? The governance distribution ultimately determines not just regulation, but system design itself, whether architectures prioritize transparency, sustainability, and inclusion, or primarily engagement and commercial metrics. The resolution requires thoughtful consideration of appropriate roles for different actors, creating balanced governance ecosystems rather than simplistic approaches giving exclusive authority to any single stakeholder group. Second, how should systems balance innovation with appropriate protection through standards establishing baseline requirements, transparency enabling informed decisions, and accountability ensuring meaningful recourse? The innovation protection balance determines whether systems can deliver genuine benefits while maintaining necessary safeguards, avoiding both innovation stifling overregulation and protection eroding under governance. The most effective approaches involve what policy specialists call innovation-enabling governance, where frameworks establish essential protections while creating clearly defined spaces for experimentation and development. This requires moving beyond simplistic regulation versus innovation dichotomies toward sophisticated frameworks, acknowledging potential synergies between appropriate governance and sustainable innovation. Finally, how should digital currencies adapt across different contexts through localization reflecting specific community needs, sovereignty respect acknowledging legitimate governance differences, and inclusion prioritization ensuring equitable access? The contextualization approach determines whether systems serve diverse requirements or impose standardized models regardless of social variations. The most promising direction involves what design theorists call adaptive architecture, where systems maintain consistency in core functions while accommodating legitimate contextual differences. This requires acknowledging that financial systems don't operate in universal contexts, but rather within specific social, economic, and political environments, requiring thoughtful adaptation rather than rigid standardization. As we complete our 5-episode journey exploring the implications of corporate digital sovereignty, let's reflect on the broader significance of these developments beyond immediate technical changes. The evolution of payment systems represents a fundamental transformation in how economic participation functions, changing not just transaction mechanics, but the governance frameworks structuring daily economic activity. This transition raises profound questions about power distribution in digital society. Who controls essential functions, how they're governed, and who benefits from their operation? The resulting landscape doesn't just transform financial services, but potentially restructures relationships between individuals, platforms, and public institutions in ways that fundamentally reshape economic participation. These developments require thoughtful engagement precisely because they occur gradually through seemingly mundane conveniences rather than dramatic revolutions. Transformation through daily choices rather than revolutionary moments. Historical monetary transitions provide crucial perspective on our current moment through pattern recognition, where technical capability typically outpaces governance understanding. Framework development where effective oversight eventually emerges despite initial gaps. And adaptation cycles where societies repeatedly navigate similar challenges despite specific differences. These patterns suggest we're currently in what historians call the critical period, between widespread adoption and governance maturation, precisely when thoughtful engagement matters most for shaping long-term outcomes. The historical perspective offers both reassurance that governance eventually adapts and caution that the adaptation quality fundamentally depends on informed public participation during crucial development phases. The key insight involves recognizing our unique position in this recurring historical cycle, the period where governance frameworks remain sufficiently flexible to be meaningfully shaped by diverse stakeholder input. As you consider these developments, recognize the significance of this particular historical moment, when corporate digital currencies have achieved sufficient adoption to demonstrate their potential, but governance frameworks remain sufficiently undeveloped to be meaningfully shaped by diverse perspectives. The decisions made during this critical period will likely establish patterns persisting for decades, determining whether these systems evolve primarily through commercial optimization or balanced approaches incorporating broader social considerations. Your engagement with these complex issues matters, because shaping technologies that increasingly structure economic participation requires precisely the awareness and thoughtful consideration you've demonstrated by exploring these questions with us. Before we conclude this series, I want to express my deep appreciation for joining us throughout this exploration of corporate digital sovereignty. Your willingness to engage with these nuanced topics reflects exactly the thoughtful participation essential for ensuring that emerging digital infrastructure serves not just commercial efficiency, but authentic human flourishing. This is Kaede, signing off from our 5-part series, and reminding you that in the evolving relationship between technology and society, the most important question isn't what capabilities new systems provide, but whether they're designed to support the kind of world we actually want to create.